Michael Burry, who is famous for spotting and shorting the housing bubble in 2008, has recently been quietly buying these stocks to add to his fund's portfolio. While Burry has been vocally bearish about the economy and the stock market, and has also placed a massive short position on Apple with put options, he's also been at the same time adding some bullish positions to other companies through his fund. In this video, we're going to take a look at those recent bullish positions and highlight 3 interesting companies that he's been buying stock in recently. The first position is in Meta, formerly known as Facebook. In the first quarter of 2022, Michael Burry bought over $17 million in Meta shares. After over a 50% decline from its recent highs, Meta currently has a price-to-earnings ratio of only 11.79, which is a very reasonable valuation compared to most of its big tech peers. Michael Burry leans towards investing in value companies as his style and likes to take contrarian investments when he believes a company is being undervalued by the market. So it's interesting to note that he's buying Meta stock here. There's been a lot of questions currently surrounding the resilience of Meta's advertising revenue, and since that makes up the bulk of its business, this has been a big overhang on the stock. It previously depended on Apple for a lot of its data for ad targeting, and its stock has taken a big hit with Apple's new privacy practices in effect and the concerns that that's creating surrounding the ad side of the business. It's hard to say what Michael Burry's exact rationale is for the investment, since that doesn't have to be disclosed to the SEC, but it's possible that he thinks that even with the advertising headwinds that Meta's currently facing, that the company is just plain undervalued at such a low PE compared to its peers. The second company that Michael Burry has been buying is in the digital advertising space as well, and it's none other than big tech conglomerate Alphabet, which is more commonly known as the parent company of Google. He bought over $18 million worth of Alphabet shares in the first quarter of 2022, and Alphabet is currently trading around a price-to-earnings ratio of 20.5 at the moment. It has a forward price-to-earnings ratio of around 16.9, which is factoring in their future growth into that calculation. With over a 25% decline from its 52-week high and the reasonable price-to-earnings ratio, Michael Burry appears to be making a contrarian bet on this company as well. Since this is the second big tech stock Michael Burry is buying in the digital advertising space, along with the Meta position that we just discussed, it seems that he might be bullish on the digital advertising space right now, or he at least thinks that it's relatively undervalued in comparison to the other areas of the market right now. These companies at the moment currently have lower price-to-earnings ratios than a lot of their peers, so the valuation's a little more reasonable there, and that's really due to a lot of the antitrust scrutiny and the recent shakeups in the ad tracking and privacy regulations like we've been talking about. The third recent addition to Michael Burry's portfolio that I want to highlight today is Warner Brothers Discovery, and it's possibly the most interesting of the companies that we've covered so far. It's actually a fairly new stock to the market, in its current form anyway, since AT&T recently divested from Warner Brothers, which it previously owned, and spun it out into a new merger with Discovery to create a new media conglomerate. This new conglomerate now includes media assets such as Warner Brothers, HBO, Discovery, DC Comics Entertainment, and more. In addition to the traditional TV channels this merger conglomerate owns, it's also looking to increase market share in the streaming space with HBO Max and Discovery Plus, and there's been discussions in the company about how to best leverage those two streaming options and maybe bundle them or something along those lines. While the company carries a fairly high debt load, it also only has a price-to-earnings ratio of 6.97, which is the cheapest price to earnings ratio of the companies that we've covered today. Michael Burry likely thinks that the stock is undervalued relative to its earnings, and there are interesting synergies that are possible with this company and maybe cost savings that can be obtained from combining these two media empires and trimming costs and scaling up with the two assets combined. So there's possible cost savings and synergies that are not currently factored into the stock price that are going to be obtained over the next coming quarters. So what do you think of Michael Burry's recent portfolio additions? Let me know in the comments, and be sure to like and subscribe if you enjoyed the content, since it really helps the channel. Thanks.